Anthony Robbins, Unshakeable, Your Financial Freedom Playbook. Embark on a journey to financial freedom with the book summary of Unshakeable, Your Financial Freedom Playbook, by Anthony Robbins. This summary will guide you through the complex world of investments by helping you recognize patterns, understand the power of compound interest, and make informed decisions using the core 4 principles. Learn how to navigate the unpredictable financial markets, minimize risk, and diversify your investment portfolio to secure your financial future.
Investing made simple. Invest early and recognize patterns to maximize compound interest. Investing can be a daunting task for many people due to its complexity. However, recognizing patterns and learning some basic concepts can make it more approachable. One crucial aspect of investing is compound interest. The earlier you start investing, the more value you can accumulate over time. By recognizing patterns in the financial market, you can find the right time to invest. Humans have an innate ability to pick up on patterns, like the regular change in seasons that allows us to plant crops at the right time. Similarly, observing patterns in the financial market can lead to long-term gains. A basic pattern to understand is the power of compound interest. It refers to the interest earned on both the initial investment and the accrued interest over time. It is advised to start taking a portion of your paycheck and investing it as soon as possible to maximize the value gained through compound interest. For instance, investing $3,600 every year from the age of 19 to 35 with a 10% average return could amass an investment worth $106,782. However, starting the investment 8 years later would result in half the return. In conclusion, investing can be simplified by recognizing patterns in the market and taking advantage of compound interest. Starting early is key to maximizing the value of investments. Mastering investment principles. The core 4 principles of expert investors helps distinguish between good and bad investment options. The first principle emphasizes minimizing losses instead of earning profits. Losses are hard to recover, so investing in safe options with limited downsides is advised. The second principle acknowledges that even the most renowned investors can't predict the financial markets. Investments that can endure unexpected market events lead to stability and profit. The 5-to-1 rule for investment success. Successful investors look for asymmetric risk-reward relationships and invest in undervalued assets. Following the second core principle of low-risk, high-reward investments, investor Paul Tudor Jones uses a 5-to-1 rule, only investing when he can expect to earn at least 5 times his initial investment. By following this rule, he can fail 80% of the time and still come out even. In addition to this, investing in undervalued assets, especially after a market downturn, can safely increase chances of rewards. After the 2008 financial crisis, the Citigroup Banking Corporation stock dropped from $57 to 97 cents per share, but within just 5 months, the price was back up to $5, a 500% increase. Investing in taxes. To make better investment decisions, it's important to know how taxes and fees impact your earnings. This summary illustrates how short-term and long-term capital gains are taxed, the difference between net and gross sums, and how mutual funds and index funds impact taxes and fees. Are you considering investing? Knowing how taxes impact your earnings is crucial. In the book's summary, Investing in Taxes, the author emphasizes that taxes and fees can consume a significant portion of your investments. Therefore, being savvy about taxes should be one of your top priorities. For instance, short-term and long-term gains are taxed at different rates and vary from state to state. It's essential to know your state's charges and whether you might save money by cashing out before 1 year has elapsed. Mutual funds, which pool investments from multiple investors, often trade their shares frequently, resulting in higher taxes on short-term gains. Understanding the difference between net and gross sums is also critical. A high return on an investment might look attractive, but it's important to know the total return after fees and taxes have been deducted. Net sums are a better indicator of the investment's quality. Investing in index funds rather than mutual funds may result in lower fees and taxes. Index funds are made up of stocks from an index and are only traded to reflect changes in the composition of the index. Unlike mutual funds, index funds don't have expensive managers, and positions are held for longer, enabling investors to avoid higher short-term tax rates on gains. In conclusion, investing in the stock market is a long-term strategy with an eye on taxes and fees. Knowing the various investment options' tax and fee implications helps you make better informed decisions. Remember that investing in index funds can ultimately lead to better returns and more money in your pocket. Diversify your portfolio. Protect your investments by diversifying your portfolio. By spreading your investments across different asset classes and markets, you lower your risk of loss when the market shifts. Don't put all your money in one asset class, instead, add more than one asset class to your portfolio. The financial markets are global, so look beyond your country's borders. Also, diversify across time by adding capital to your portfolio regularly to improve your chances of latching on to a new trend. Rules for rational investing. Humans are wired to respond irrationally to financial threats, which is why checklists and rules are crucial for rational investment decisions. The brain's response to losing money is akin to a threat to our survival, leading to hasty decisions. However, investing during stock market crashes can be profitable, making rules and checklists crucial in making rational decisions. Paul Tudor Jones' 5-to-1 rule is an example of using a list of criteria to make rational investment decisions. Rules and checklists protect from making reactionary decisions and turn decision-making into a reliable discipline.
In conclusion, Unshakeable, Your Financial Freedom Playbook, offers valuable insights and practical advice for navigating the intimidating world of investments. The book emphasizes the importance of pattern recognition, starting early with investments, and following the core 4 principles, focusing on avoiding losses, seeking low-risk investments with high rewards, being tax-savvy, and diversifying your portfolio. By understanding these key concepts and practicing rational decision-making, you can overcome your instincts and build a solid financial foundation for your future.